The Federal Reserve just conducted its annual stress test on the largest banks in America. Every major institution passed. Regulators assured markets the financial system remains resilient. But while they were testing for corporate loan defaults and real estate crashes, something far more dangerous was happening in a corner of the market they didn't even examine. Silver collateral is repricing violently. Repo markets are spiking, and the very structure that keeps short-term funding flowing is starting to crack. This isn't a story about precious metal speculation. This is about the plumbing of global finance breaking down in real time, and almost nobody is paying attention. Here's what's happening. Industrial metals, especially silver, are used as collateral in repurchase agreements. These are overnight loans that banks, hedge funds, and corporations use to fund their operations. Silver has always been valued as collateral because it's liquid, globally recognized, and stable enough to serve as a placeholder for cash. But in recent weeks, silver prices have become wildly volatile. That volatility is forcing repo desks to reprice the collateral value downward. When collateral gets repriced, borrowers have to post more of it or pay higher interest rates. Repo rates, which had been sitting comfortably below 2%, have spiked to 3% in certain markets. That's a 50% increase in the cost of overnight funding, and it's happening at the exact moment when liquidity is already thin and risk limits are being tightened across every major trading desk in New York and London. What the stress tests missed is this. They modeled for credit risk and market risk in isolation. They didn't model for collateral chain risk. They didn't ask what happens when the thing you use to secure short-term loans suddenly becomes unreliable. And they definitely didn't ask what happens when hedge funds that have been writing covered calls and shorting volatility on silver suddenly see their hedge books unravel, because that's exactly what's happening right now. Derivatives desks are scrambling, risk managers are pulling back exposure, and funding desks are quietly flashing red. This move didn't come out of nowhere. To understand why this moment is so dangerous, we need to go back and look at how silver became embedded in the financial system as collateral in the first place. For decades, silver occupied a strange dual role. It was both an industrial commodity and a monetary metal. Unlike gold, which is almost purely a store of value, silver is consumed. It goes into solar panels, electronics, medical devices, and batteries. That industrial demand gave it a floor price, but it also retained its historical monetary properties. Central banks didn't hold much of it anymore, but private market participants did, and crucially, it was accepted as collateral in repo markets. Repo markets are the unseen backbone of modern finance. Every day, trillions of dollars in short-term loans are made using securities or commodities as collateral. A hedge fund might borrow cash overnight and post treasury bonds. A corporation might post corporate bonds. A trading desk might post silver or gold. The lender holds the collateral and returns it the next day when the loan is repaid. This system works smoothly as long as the collateral is stable and liquid. The moment it becomes volatile or hard to sell, the entire chain starts to wobble. Silver's role in this system expanded dramatically after the financial crisis of 2008. Regulators pushed for more collateralization in derivatives markets. Clearing houses required more margin. Banks needed more high-quality liquid assets. Silver fit the bill. It was globally traded, had deep markets, and wasn't subject to the same regulatory scrutiny as sovereign debt. So repo desks started accepting it more widely. Hedge funds started using it to lever up their positions. And a whole ecosystem of financing grew up around it. For years this worked fine. Silver traded in a relatively narrow range. Volatility was low. Collateral haircuts, the discount applied to the value of silver when used as collateral, were small. A bar of silver worth $10,000 might be valued at $9,500 in a repo transaction. That 5% haircut was enough to protect the lender if the price dropped slightly overnight, but it assumed silver wouldn't move violently. It assumed the market would remain liquid, and it assumed that everyone using silver as collateral wasn't doing the same trade at the same time. All three of those assumptions are now breaking down. In the past 6 months, silver has seen price swings of 5 to 8% in a single session. That's extraordinary for a commodity that's supposed to be stable enough to use as collateral. Those swings are being driven by a combination of factors. Industrial demand is surging because of the energy transition. Solar panel production is consuming silver at record rates. At the same time, above-ground supply is tight. Miners haven't been investing in new capacity. Recycling can't keep up. And speculative interest has returned to the market as inflation fears and geopolitical tensions push investors toward hard assets. But the real catalyst for the chaos we're seeing now is the derivatives market. Silver has a massive options and futures market. Hedge funds and trading desks have been selling volatility for years. They write covered calls, collect premiums, and assume that silver will stay calm. That trade worked beautifully in a low volatility environment. But when volatility explodes, those positions become toxic. The funds that sold calls now have to hedge by buying silver or silver futures. That buying pushes prices higher, which increases volatility further, which triggers more hedging. It's a feedback loop. And that's exactly what's happening right now. As volatility has spiked, repo desks have responded by increasing haircuts. That $10,000 bar of silver might now be valued at only $8,000 in a repo transaction. That's a 20% haircut, 4 times what it was a year ago. For a hedge fund that's been using silver to finance a large portion of its book, that's a catastrophic change. Suddenly, they need to post more collateral or reduce their positions. If they can't post more, they have to sell. And if everyone is selling at once, the price drops, which triggers more margin calls, which forces more selling. This is how collateral crises spiral. What's making this worse is that it's happening at a time when risk limits are already being tightened. Every major bank has a risk limit on how much exposure its trading desks can have to any single asset or market. Those limits are set by risk committees and are supposed to prevent the kind of concentrated bets that blew up long-term capital management or Lehman Brothers. But in practice, those limits are often adjusted based on recent volatility. When markets are calm, limits are loose. When volatility spikes, limits get tightened. And right now, volatility is spiking across multiple markets at once. Equity volatility is elevated. Interest rate volatility is high. Currency markets are choppy. And now industrial metals are moving wildly. So risk managers are pulling back. They're telling traders to reduce position sizes. They're cutting exposure to anything that looks remotely risky. And that includes silver. Trading desks that might have been willing to take the other side of a repo transaction a few months ago are now stepping back. They don't want the exposure. They don't want the balance sheet usage. And they definitely don't want to be the ones holding devalued collateral if this turns into a full-blown crisis. That pullback in liquidity is what's driving repo rates higher. When fewer desks are willing to lend against silver, the cost of borrowing goes up. It's supply and demand. But for funding, the spike in repo rates is the warning signal that something is breaking. Repo rates are supposed to track the Federal Reserve's policy rate closely. When the Fed funds rate is at 5.33%, repo rates should be in that range as well, maybe a few basis points higher or lower depending on the collateral. But when repo rates for silver collateral jump to 3% above the Fed funds rate, that's a massive dislocation. It means the market is pricing in serious risk. It means lenders are demanding a huge premium to take on that collateral. And it means borrowers are getting desperate. What traditional media is not reporting is the extent to which this is connected to broader funding stress in the financial system. The narrative you'll hear is that silver is just a volatile commodity, and that some hedge funds made bad bets. That's true, but it misses the bigger picture. Silver collateral isn't isolated. It's part of a vast web of interconnected funding arrangements. A hedge fund that can't roll over its silver repo might have to sell other assets to raise cash. That selling pressure hits equity markets, bond markets, or other commodity markets. Meanwhile, the banks that were lending against silver are now facing losses on those loans if the collateral value has fallen. Those losses eat into their capital buffers, which makes them more cautious about lending elsewhere. The whole system tightens, and this is happening at a time when the Federal Reserve is still running quantitative tightening. They're draining reserves from the banking system. There's less cash sloshing around. Banks are more protective of their balance sheets. And now, on top of that, a major category of collateral is becoming unreliable. It's a perfect storm for a funding crisis. The pieces are all in place. The question is whether the Fed and other regulators recognize it before it's too late. There's another dimension to this that's being completely ignored. Silver isn't just collateral for hedge funds. It's also used by corporations, especially in Asia, to secure trade finance. A Chinese electronics manufacturer might use silver as collateral to get a loan to buy components. A solar panel producer might pledge silver stocks to finance inventory. When that collateral gets repriced, those companies face the same margin calls that hedge funds do, and many of them are far less sophisticated. They don't have risk management teams, they don't have backup credit lines, they just have silver that they thought was worth a certain amount, and now it's worth less. Some of those companies will default. Some of those defaults will cascade into the banks that lent to them. And those banks, many of which are regional or second-tier institutions, don't have the capital buffers that JP Morgan or Goldman Sachs have. This is also playing out against the backdrop of a massive buildup in silver demand from the energy transition. Governments around the world are mandating solar installations. The Biden administration's Inflation Reduction Act is pouring subsidies into renewable energy. Europe is doing the same. China is the largest producer of solar panels, and they consume enormous amounts of silver. That structural demand is real and it's not going away. But in the short term, it's creating a supply crunch. Miners can't ramp up production overnight. It takes years to bring a new mine online. So prices are being driven by a fundamental supply-demand imbalance. And that imbalance is colliding with the financial engineering that's been built on top of the silver market. Here's the hidden connection that almost nobody is talking about. A significant portion of the silver market is controlled by a small number of large players. There are industrial users like solar manufacturers. There are financial players like bullion banks and hedge funds. And there are sovereign and quasi-sovereign entities that hold silver as part of strategic reserves. When prices start moving violently, these players don't act independently. They watch each other. If a major bullion bank starts pulling back from the repo market, others follow. If a large industrial user starts hedging aggressively, that sends a signal. The market is thinner and more concentrated than most people realize. And in a thin market, small moves can trigger big dislocations. The timing of this is also important. We're heading into the second half of the year, which is typically when liquidity gets thinner. Traders go on vacation. Trading desks reduce risk ahead of the summer. And central banks are less active. That seasonal thinning of liquidity makes markets more fragile. A shock that might be absorbed easily in January or February can cause a much bigger move in July or August. And right now, we're seeing that fragility play out in real time. What's also crucial to understand is that the Fed's stress tests are backward-looking. They model scenarios based on historical data. They assume that correlations and volatilities will behave the way they have in the past. But financial crises don't happen because things behave the way they always have. They happen because things break in unexpected ways. In 2008, the models didn't predict that subprime mortgages would default in huge numbers and that those defaults would cascade through the entire financial system. The models assumed housing prices wouldn't fall nationwide. They were wrong. Right now, the models assume that collateral markets are stable and that repo funding will always be available. They're not stress testing for a scenario where a key category of collateral becomes unreliable. And that's exactly the scenario we're living through. At this point, I need to step back from emotion and look at this through a realist lens. Financial systems are built on confidence and leverage. Confidence that collateral will hold its value. Confidence that counterparties will meet their obligations. Confidence that liquidity will be there when you need it. When that confidence starts to erode, leverage becomes a vulnerability, and the entire structure can unravel very quickly. What we're seeing in the silver collateral market is an early warning sign that confidence is eroding. Repo desks are demanding higher rates because they're less confident in the collateral. Risk managers are tightening limits because they're less confident in their models. And market participants are pulling back because they're less confident in liquidity. The rational response for any individual institution is to protect itself. Pull back exposure, demand more collateral, charge higher rates. But when every institution does this at the same time, the collective result is a liquidity crisis. This is the paradox of financial systems. Individual rationality leads to collective instability. And right now, we're watching that dynamic play out in slow motion. The repo spike is the signal. The collateral repricing is the mechanism. And the tightening of risk limits is the accelerant. History shows us that collateral crises can escalate very quickly. In 2008, the crisis in subprime mortgages spread to the entire structured credit market within months. Lehman Brothers collapsed not because of direct exposure to bad loans, but because it couldn't roll over its short-term funding. Its collateral was no longer trusted, counterparties pulled back, and the firm went from solvent to bankrupt in a matter of days. We're not there yet with silver collateral, but the mechanisms are the same. Trust is eroding, funding is getting more expensive, and the institutions most exposed are scrambling to reduce risk. The other lesson from history is that regulators are always late. They regulate the last crisis, not the next one. After 2008, they focused on bank capital and mortgage underwriting. They didn't focus on repo markets or collateral chains. After the pandemic, they focused on pandemic preparedness and supply chain resilience. They didn't focus on commodity, collateral, or derivatives hedging. And right now, they're focused on inflation and interest rate risk. They're not focused on the unraveling of silver collateral and what that means for funding markets. By the time they do focus on it, it may be too late. This isn't just about silver. The consequences will ripple through multiple markets. If repo rates stay elevated, that increases the cost of leverage for every hedge fund, every trading desk, and every corporation that relies on short-term funding. Higher funding costs mean lower asset prices. Lower asset prices mean margin calls. Margin calls mean forced selling, and forced selling creates a downward spiral. We've seen this movie before. It doesn't end well. For the entire commodities complex, this move is a warning shot. If silver collateral can reprice violently and disrupt funding markets, so can other industrial metals. Copper is used as collateral. Aluminum is used as collateral. Even oil and natural gas are used in structured financing arrangements. If market participants start questioning the reliability of commodity collateral in general, the repricing won't be limited to silver. It will spread. And when it spreads, the funding stress will intensify. The international financial system faces a deeper structural problem. For decades, the system has been built on the assumption that there will always be a deep, liquid market for collateral. That assumption is breaking down. As central banks have tightened policy and drained liquidity, markets have become thinner. As geopolitical tensions have risen, cross-border flows have become more restricted. And as regulatory scrutiny has increased, banks have become more cautious about what collateral they accept. The result is a system that's more fragile than it appears, and silver is just the first stress point to crack. In the next 5 to 10 years, we're going to see more of these collateral crises. They'll happen in different markets and for different reasons. But the underlying dynamic will be the same. Leverage built on overconfident assumptions about liquidity and collateral stability. And when those assumptions break, the system wobbles. The question is whether regulators and central banks will recognize the pattern and act preemptively, or whether they'll wait until a full-blown crisis forces their hand. Based on history, the smart bet is on the latter. There's also a personal impact here that shouldn't be ignored. This means that prices for goods that depend on silver, like electronics and solar panels, could become more expensive or harder to get. If manufacturers can't secure financing because their collateral is unreliable, production slows. If production slows, prices rise, and consumers pay the cost. It's not just an abstract financial market problem. It filters down into the real economy. For the entire energy transition, this move represents a serious obstacle. Solar power depends on silver. If the financing for silver becomes unstable, it creates uncertainty for the entire supply chain. Companies that are planning massive solar deployments now have to factor in the risk that silver prices could spike, or that financing could dry up. That uncertainty slows investment, and slower investment means slower progress toward renewable energy goals. The irony is that the energy transition is driving silver demand, but the financial instability created by that demand is now threatening the transition itself. Silver has demonstrated that no collateral is immune to repricing risk when volatility explodes and liquidity thins. What we're witnessing is not a temporary blip in a volatile commodity market, but a fundamental stress test of the collateral chains that underpin modern finance. The repo spike is the alarm bell. The hedge book unraveling is the mechanism, and the tightening of risk limits is the feedback loop that turns a problem into a crisis. This move marks a turning point. It exposes the fragility of a financial system that has relied on stable collateral and abundant liquidity for too long. When those pillars shake, everything built on top of them becomes unstable. The Federal Reserve missed this in their stress tests because they were looking in the wrong places. They were testing for the last crisis, not the next one. And by the time they realize what's happening in the repo markets and the collateral chains, the damage may already be done. The unipolar assumption that collateral is always stable and funding is always available is cracking, and silver is the fracture line.